time you have. You may say, I'm going to read through the budget speech, but you may never have that time. So this is the time for you and to learn, to understand what this budget means, and also or the tax amendments. Of course, we take note that some of the appropriation figures were made sometime back, maybe a month ago, 3 months ago, but discussion now is more strategic for us in how we will navigate the upcoming financial year, whose budget has been read us yesterday. So on that note, I want to take this honor to introduce our first presenter. Our first presenter is Mr. Nicholas, Mr. Henry Kalolo. Sorry, Henry, you was calling me Nicholas actually when you were also calling me. So the name sort of tagged. So our presenter is Mr. Henry Kalolo. Henry is a principal economist, Minister of Finance, Planning and Economic Development. Henry, before he was made principal economist, he also worked as economist, budget policy and evaluation. I also worked in the budget policy and evaluation department as a principal, as a senior economist and an economist. So he has risen through those ranks, the current role. Henry, of course, heads the budget execution section of Ministry of Finance, Planning and Economic Development, and he leads in making sure that the national budget is balanced. That is, expenditure does not exceed the revenue projections. He also ensures that the detailed budget across ministries, departments, agencies does not exceed the approved budget. And he makes sure that in his advisory role to the government as a principal economist, make sure that the budget is executed in line with what has been approved. So we are with the authority to teach us exactly what this budget meant, so that we understand it more as professionals. So thank you. Please join me to welcome Mr. Henry Karolo will take us through this session. Henry, you are most welcome. You may unmute and speak to the professional accountants. Thank you so much.
Okay, thank you, Ambrose, for that wonderful introduction. I hope you can hear me.
Yes, sir.
Okay. Thank you. First of all, I'm sorry that I was a bit late. I got interfered with on my way to set myself up. And as you correctly introduced, I've been in the budget execution section for a period of now 15 years. And our role in this section is to make sure that the budget is, that the numbers talk, that the revenue is equal to the expenditure at an aggregate level. And as you mentioned, now we are going into the detailed budget estimates level. This is where, yes, there were numbers read for say, wealth creation, but institutions have to now break it down to the very detailed level and submit it to Ministry of Finance. So for us, while the budget has been read, we are now telling the institutions to give us the final breakdown in line with what was approved by Parliament. But thank you once again for welcoming me to this webinar. This is going to be my presentation, it will be outlined as follows: an introduction, a brief economic outlook. Really, the Honorable Minister presented this yesterday, and I'll just highlight a few that he presented. I won't go through this a lot because it's in the budget speech. If you'd like a soft copy, I have that one as well. We'll look at the priorities, where I think is what usually interest is around these priorities for next financial year. And I'll pick out some of the ones that the minister didn't mention in his speech, so that at least they can be more detailed that I'll provide, and then just a conclusion. So as mentioned by the Honorable Minister in his speech yesterday, the budget for next financial year is based on mostly two things: implementation of the current government's manifesto and the fourth National Development Plan. And in the next 15 years, the national development plans are going to be based on what we are calling the tenfold economic growth strategy. This strategy is looking at expanding the size of our economy from $61.3 billion this financial year to $500 billion by 2040, in 15 years. So this strategy is the one that is guiding budget priorities and allocations and all national development plans. And the strategy is mostly anchored on what we are calling ATMs, which is agro-industrialization, tourism, minerals, and STI, science, technology, and innovation. We shall come to that later. In the economic outlook, the Honorable Minister yesterday took time to go through this, so I don't want to spend so much time on this, apart from saying that the economy is expected to grow by 6% this financial year, and in next financial year, 7%. That is the GDP growth. And then we are expecting that with the onset of oil and gas, production will grow to double digits. And the GDP is now projected at $66.1 billion for 25-26. And as I mentioned earlier, for this financial year, it's $61.3 billion. So next financial year, the GDP per capita is higher at 1,324 USD compared to this year at 1,263. Inflation has remained subdued, and as of May, it is at 3.4% compared to 4.1% at this time last year. And it's expected to remain below the policy target of 5% per year. That is government's policy target, to keep inflation at that level. Interest rates have reduced to an average of 17.7% from 18.1% in November 2024. And this is mainly because BOU has reduced their reference interest rate, and there are less riskier borrowers who are accessing funding. The exchange rate, it has appreciated by 4% year on year in April 2025 compared to 2024. And it's one of the best performing in Africa. Then private sector credit has grown to 23.3 trillion from 21.9 trillion in June 2024. So these are what I would call the usual fundamentals that we usually pick out especially when we are communicating every quarter. These are the key ones, and the minister ably explained them, and I don't want to spend a lot of time on these ones. I thought this would be more important to this webinar, the government resources for financial year 25-26 and compared to 24-25. And as you can see, domestic resources, we are saying we are expecting to collect 48.9 trillion from domestic resources. URA, is expected to collect 33.9 trillion. We have non-tax revenue. These are things like passports, passports, let's say national IDs as well, tuition from universities is 3.2 trillion. And these days, URA also collects this funding. We are not expecting to withdraw any money from the petroleum fund next year. We are expecting to borrow 11.3 trillion from the domestic market, which we call net domestic financing. This is to support the budget. Local revenues, we expect local governments to collect 328 billion, which they spend at source. Then when we go to the external sector, to the external sources, sorry, we're expecting to raise 13.4 trillion or 21% of the resources from external sources. Budget support, 2 trillion. This is mostly concessional funding from IMF, ADB, and the like. Then project support, this is mostly what we call capital expenditure that is externally financed. So this is 11.32 trillion. This is earmarked for projects. Now we have what usually disturbs us to explain, which is domestic debt refinancing of 10.02 trillion. This one is usually problematic. People ask us why we include it in the budget. And the reason why we do that is simple. This is domestic debt that ideally we should be paying this financial year, but we are not going to pay it. Therefore, we shall roll it over. We shall simply refinance it. Instead of paying it, we shall borrow this 10 trillion from the domestic market again and push it forward to pay at a later date in time. So our total resource envelope is 72.376 trillion. Domestic resources are 48, external is 13.1, and then when you add the 10, you come up to the 72.376 trillion. If I go to the pie chart on the next slide, you can see taxes are amounting to about 55%. Projects are the next big ones at 18%. And net domestic borrowing, the one that we're going to use to support the budget, is 18%. NTR is 5%. Budget support, like I mentioned, concessional financing is 3%. Then a very small amount of local revenue collected by local governments at 1%. So this is I put a star there to let you know that here we are not incorporating the domestic debt refinancing in this pie chart. Yeah, as I said, this refinancing, and we are going to see it in the next slide, is not really what we consider as an expenditure in Ministry of Finance, because you're just rolling over the debt. And here we come to the summarized government expenditure by category. We like calling this by economic classification. As you can see, the recurrent expenditure from last year is slightly going down from 67% of the budget to 66% of the budget. However, wage is increasing to 8.5 trillion. Non-wage without interest payments is 17 trillion, which is also increasing, and then interest payments at 11.3. So we are looking at an increase of about 1.7 trillion in interest payments. Capital development expenditure, which we call capital expenditure, you can see we have scaled up on GOU from 5.9 this year. We are increasing it to 6.9 next year. And also the projects are increasing from 9.5 to 11.3 trillion next year. Then historically, we have removed this from our expenditure categorization. Amortization, which is domestic arrears first, of 1.4 trillion next financial year. I'm sorry for the noise. Domestic arrears, we are increasing the domestic arrears provision from this year of 200 billion to 1.4 trillion. This is a big significant change. Amortization, which is external debt payments, we're increasing them from 3 trillion to 4.9 trillion. There's nothing much that can be done there. Domestic refinancing of 10 trillion. Now, as I mentioned to you earlier, this is an expenditure that is in and out. It's a resource you borrow, but at the same time for us, in order to have a balanced budget, we are forced to consider it as an expenditure because these funds must go out of the consolidated fund. But like I mentioned, it's really a refinancing issue. We are paying Bank of Uganda a debt of 493 billion, and then local government expenditure from locally collected revenue is 328 billion. We categorize it like this because of historical purposes. Local governments, we try to separate their expenditure and revenue from the rest of their locally collected revenue and expenditure from the rest of the budget. So as you can see, this is how the budget for next financial year is broken down by economic category. So you can see how much is wage, how much is non-wage, how much is interest payments, how much we are spending on capital expenditure, which is 18 trillion. That is both from GOU sides and external. You can see a big change in policy on domestic arrears, and then a slight reduction in refinancing. So I'll just show this this table that shows the program allocations from financial year 2021-22. The National Planning Authority came up with the organization of our budget along various programs. So you can see the big winner here is human capital development with 11.4 trillion. We have governance and security with 9.8 trillion. We have infrastructure, 6.3 trillion. Development plan implementation, 2.7 trillion. Private sector development, 2.7. Agro, 1.8, and so on and so forth. But as you can see, the big winners there are human capital, is human capital development. But then again, questions would arise: what is in human capital, what is in governance, what is in transport, what is in DPI. Previously in human capital, when we still had sectors, we had education sector and health sector, and this is now what has been consolidated into this program called the Human Capital Development Program. So now what I'll try to do is try to give some few highlights on expenditure priorities. And like I mentioned earlier, the tenfold growth strategy is based on what we have termed as the ATMs. ATMs are agro-industrialization, tourism, minerals and oil and gas, and science, technology, and innovation. So this is what is driving government strategy over the next 15 years, and which is going to guide the national development, the subsequent national development plans. This is the bedrock of our strategy. And under agro-industrialization, as the minister clarified yesterday, there's an allocation of 1.86 trillion. Priority areas are these ones that are provided: inputs and technologies, water, irrigation and infrastructure, disease and pest management, research, standards, certification and market access, and agricultural financing. Now here, what I try to do is pull out some few that that you cannot get in the budget speech or are difficult to get in our budget documents. For example, under seed multiplication, I thought it would be interesting to know that there's 80 billion for coffee, of which 60 billion is going to introduction of coffee in northern Uganda. I thought this would be interesting to highlight because I know for sure it's not in the budget speech. Fertilizer production, I thought it would be important to highlight that 104 billion has been earmarked for a factory known as Intracom Fertilizer Factory in Kampiringisa. This is an earmarked intervention for the factory to package fertilizer. So I thought that would be something that I would highlight. Under agro-processing technologies and tractors, there's 25 billion that has been earmarked for tractors, but that one I didn't think it's big enough to put here. Then, of course, there are those interventions under irrigation, construction of water storage and irrigation facilities, establishment of post-harvest handling, storage and processing infrastructure. Then MAIF, of course, that is Ministry of Agriculture, Animal Industry and Fisheries, has to deal with pests, diseases, and vectors across livestock, crops, and fisheries. Then, of course, we have research, extension, and capacity building. This is mostly for NARO. NARO also has interventions that it undertakes under this program. Standard certification and market access. I think we have provided an additional 20 billion for these interventions, enforcement of quality and standards, online export certification system that the EU wants. I think we have provided 18 billion for that. Then agriculture financing, there's 50 billion for the agriculture credit facility, and we shall come back to that later. So this is what is under agro-industrialization. This is what the minister read yesterday, but I thought I could mention a few things like coffee, 80 billion, fertilizer, 104 billion, and the 25 billion for tractors, purchase of tractors. So this is what is under the agro-industrialization program. Now, if you go to tourism program, tourism was a big winner in this financial year. It has a direct allocation of 430 billion. But there are other investment in tourism enablers, and the minister mentioned about 2 trillion there. So here under tourism, there's branding and marketing that has been supported. We are expecting comprehensive international and domestic media campaigns, digital promotion. Some influencers will be engaged, and some tourism ambassadors. We are going to leverage AFCON and global platforms like international sports. AFCON, I thought here it would be important to mention that this year we have invested 417 billion. The minister mentioned it in his speech. I'll have to check. But I thought what I could mention here is AFCON next financial year, 596 billion has been earmarked for interventions towards AFCON. Then there's experiential tourism through birding, culinary festivals, fishing, and golf tournaments. I should also mention that the rugby, African rugby tournament has been supported with, I think, 5 billion under the sports platform. But I wish to clarify that sports is actually not under this program. It's under the Human Capital Development Program, but we're just going to leverage this. Under tourism infrastructure, we have provided some funding for construction of sanitation infrastructure at tourism sites, and then development of refreshment centers, signage, and public sanitary facilities. Then strengthening tourism security enhancement. Then hospitality standards and capacity building. This is mostly under Uganda Hotel Training Institute in Jinja, and we have provided support to that one as well. Health tourism, I think you have. We are going to get to health program, and we'll mention a few things there. And of course, there's Lubowa, which people don't want to hear about, but that one is also moving quickly. We have economic and commercial diplomacy. 120 billion has been provided to Uganda foreign missions to support this initiative. Yeah? It's both economic, commercial, and tourism related diplomacy. Now, as I mentioned, the direct allocation to tourism is 430 billion. It's going to institutions like Uganda Uganda Wildlife Authority. Is going to UTB, which is mostly in charge of the marketing. But we have other related expenditures that are not necessarily in tourism. For example, as I mentioned, AFCON, the 596. Don't ask me that the tourism budget is 430, but AFCON is 596. That is because it's in another program, but it's related to tourism. Mineral-based industrial development, 957 billion there. Apologies, I'm not so sure about this number. I'll have to check. Sorry, if you'll allow me to go back. Minerals, that is sustainable extractives industry development. It should be 875. My apologies. I need to update that. Apologies on that, but this mineral-based industrial development is under this program that we are calling Sustainable Extractives Program. So under there, of course, we have mineral resource assessment and valuation. A lot is being done, especially quantification and mapping of Uganda's mineral resources. Especially, I think this is being done in Karamoja. I'll check if anyone wants information on that. Governance and regulatory framework, we are trying to improve that. It has been a blind spot, and I think the Minerals Act has now been passed. We are providing support to the National Mining Company. 6 billion has been provided for next financial year. Fast tracking the construction of the ECOP. This is not changing. Prioritizing development of the oil refinery as well. Then industrialization through strategic hubs. Kabalega International Park is being developed. The land was bought this financial year. And then regional integration and strategic partnerships. So when you see this program of sustainable extractives, this is where mineral-based industrial development, including oil and gas, are. And as I mentioned, it's 857 billion. Then we have STI. This is science, technology, and ICT. We have a number of interventions here. So here we have directive interventions in ICT. That is 361 billion. This is going to the ministry. It's going to NITA to work on the backbone. Then we have STI itself, where you have Kira Motors, you have the banana industrial project in Bushenyi. Then we have vaccine development, including anti-tick vaccine, sericulture, and some STI initiatives. Under here, we have 68 billion for creative arts industry that was mentioned by the minister. There's a 38 billion for the creative arts to create a home. You can call it a yoga wood if you wish. And then about 20, I think it's 28 billion for a revolving fund for the artists to borrow from that revolving fund. It becomes as similar to what we have in the women entrepreneurship program. So they also have a fund there, and then 5 billion for support to copyright law enhancement. So the creative artists are also benefiting from next financial year with 68 billion. Now, other priorities under human capital development. I think the Honorable Minister here mostly talked about the allocations at at a higher level. So under health, what I wanted to highlight is salaries for health workers in local governments. This is now Health Center 2, Health Center 3, Health Center 4, general hospitals. They take a huge chunk of the health budget. That's 939 billion. And that's why we are investing a lot in the health system that can track whether doctors at work at health centers or not. Essential drugs and medicine under NMS, 717 billion is part of the budget for next financial year. Referral hospitals, when you aggregate the amount of funding going to referral hospitals, you find that 535 billion is going next financial year to all referral hospitals, of which Mulago gets the largest share at 138 billion. Remember, we have a referral system in Uganda. You start from the Health Center 2, then Health Center 3, then after they refer you to the regional referral hospitals, who, if they can't handle the issue, refer you to the national referral hospital. And that's why Mulago, you see, has a big chunk of 138 billion. Cancer Institute, 226 billion. You can see that a lot has been Cancer Institute has been prioritized. We actually provided an additional 90 billion to them. They had 220 minus 90, that is what, 130. So at the time of finalizing their budget, we added them an additional 90 billion to ensure that they can, they are running some specific projects under Cancer Institute where they are scaling up treatment of cancer because, as you are all aware, NCDs are on the rise, and that is why you can see that it has a significantly high budget. Heart Institute has 118 billion, and then Ministry of Health itself has 1.5 trillion. But the reason why Ministry of Health has such a high budget is because they are the ones who implement this project called Health System Strengthening for HIV and AIDS that is funded by the World Bank. So the World Bank implements this 1 trillion project through the Ministry of Health, supporting the health systems for HIV and AIDS, including drugs and the like. Under education, again, salaries for local governments. This is primary schools, secondary schools, and skills development. They take the huge chunk, 2 trillion. And once again, that's why government is investing in the IT systems. We have a system called TELA, Teacher Effectiveness and Learner Assessment, whereby now the Ministry of Education can log in and see which teacher is where, who is teaching, who is not teaching, and also to make sure that there are no ghosts in these institutions. Because you can see that the salaries are taking a very significant amount of money in this human capital development program. Like if you get the 2 trillion and add more or less, that's a 1 trillion in health, that is 3 trillion, that's a big amount. Universities have 1.26 trillion. Now here I aggregated all universities, that's Makerere, MUBS, Kulu University, Soroti, Lira, Mountains of the Moon, Busitema. I also added UMI here, and that is why you see that universities have an allocation of 1.2 trillion, and Makerere has, of course, the biggest amount here, 390 billion. Now, just to digress a bit, all this 1.2 trillion, if some of you might be aware, government switched policy and took over the wage bill of all universities. And indeed, because of this, all tuition collected by universities it comes to the consolidated fund. Yeah, this does not mean that we do not release funds for universities, and you'll never hear any complaints from them. But universities of this 1.2 trillion, they collect about 30%, which is about 400 billion. So the government provides more or less 70%. That would be maybe 800 billion, more or less. UNEB 160 billion. So these are the big hitters under the Human Capital Development Program that we solve 11 trillion. And as I mentioned earlier, National Council of Sports, because AFCON is coming up, there's an allocation to National Council of Sports of 503 billion for next financial year. It's going to Akibua Stadium, completion of Hoima Stadium, all those training facilities that are coming up, and finalization of Nambole Stadium as well. If you want details, let me know. This is public information. We can share it without any problem. SAGE, which is a social assistance grant for the elderly, is 121 billion. So I thought it would be, this would give you a bit of details into what is under the human, where the expenditure is under the Human Capital Development Program. Of course, there are others that I haven't gone into, but these are the big amounts under this program. Then other priorities, as I mentioned, the tenfold growth strategies around the ATMs and what we are calling enablers. Enablers are the supporting sectors like health, like infrastructure, like security and governance. So here I try to pull out the wealth creation funds. The minister, once again, the Honorable Minister, once again, read these ones in the budget speech, but just to emphasize, 1 trillion for PDM next financial year. So far, we have put 3.3 trillion, and this will increase the amounts to 4.3 trillion once this is released. Grow is a big opportunity for women, 231 billion. Emioga is not stopping, 100 billion. 58 billion for the presidential zonal industrial hubs and skilling initiatives. This is under State House. 50 billion for the ACF, Agriculture Credit Facility. Invite program, which is a new program supported by the World Bank, 275 billion. UDC, which is government's investment arm, 187 billion. Capitalization of Bank of Uganda. We have 1 trillion here, but what we are actually going to give UDB is 417 billion. The rest are guarantees that are provided by Ministry of Finance. That's why you see the 1 trillion, but in a sense, the cash that is coming from the collections is 417 billion. Support to Microfinance Center, who also do some things there, is 48.5 billion. So these ones are Honorable Minister already mentioned, but they're important for me to mention here because they are critical, they are priorities next financial year, and you can be sure that they will be funded, and they'll be funded when they need the money, and as soon as they need it, they will get it. So that's why I'm highlighting them. Other priorities, I highlighted governance. There's a typo there, my apologies. Under MODVA, that's Ministry of Defense and Veteran Affairs, that should be shillings, SHS. So it's 4.9 trillion, and of course, defense is taking a quite significant amount of money in the budget because of salary enhancements and the like. But they have a 200 billion that is from external financing. Yes, it may be hard to believe, but the AMISOM project supports the UPDF on that as well. Electoral Commission, the Honorable Minister mentioned that they have been sufficiently funded for the elections, and that is 590 billion that they're getting next financial year. Police, 1.2 trillion, prisons, 529, State House, 500 billion, ISO and ESO consolidated, 364 billion. How we are going to get our national IDs, 254 billion. I thought it's important to mention immigration, 190 billion. And they're prioritized usually in the early on in the financial year so that they can procure passports, such that when Ugandans need the passports, they quickly get them. Auditor General 100 billion and IG 79 billion. So these are the big amounts of expenditure under this program that we are calling the Governance and Security Program. That's why you see it has Auditor General, it has Inspectorate of Governance. But those are the key ones that I thought I would mention. Now, unfortunately, I didn't put infrastructure of 4.9 trillion here, but you will recall that UNRWA and Road Fund were moved into the Ministry of Works. So that money under infrastructure is mostly under Ministry of Works, both for maintenance and for road construction. So I picked out the two big ones because I thought they were of interest, and also the wealth creation funds because they are also mostly of interest, and whereas they appear that they are recurrent expenditure, we budget for them as recurrent expenditure. Really, what happens is that they are going out for investment, more or less investment purposes. So what are the key policy issues that I wanted to highlight that we usually get questions on? The first one is I wish you to note the allocation for domestic areas of 1.4 trillion. This is a big policy shift. Government wants to eradicate all areas in 3 financial years, and it is starting with 1.4 trillion next financial year. This is a big one, and Ministry of Finance is going to focus on this a lot during execution. And if you manage to hear one of our press conferences from our peers, you're going to be hearing a lot about clearing of domestic areas, which have really become a problem. I wanted to mention a concept of the Treasury single account. A lot of accountants ask us about unspent balances. We no longer have this issue called unspent balances that are returned to the Treasury. No, we no longer have that. The government now runs a Treasury single account. All government institutions pay through the central bank. All ministries pay through the central bank. All the accounts are in the central bank. On June, today is June 13th. On June 30th, all access to the Treasury single account will be stopped, and there's nothing that will return to the UCF because we run our budget is very tight. So there's no institution which has money and they say that they return it to the UCF. No, we shall just stop access to the UCF. Whoever hasn't spent, sorry for them by that time, but the appropriation has expired. And as I mentioned, we run a cash budget, so it's very, very tight. So there's usually we don't end with a surplus. We have off-budget expenditure. We have off-budget expenditure, especially in health. They are not part of the budget. Apologies, sorry, just a second. Off-budget expenditure in health, they are not part of the budget, especially these USAID expenditures that people keep asking us about. So we cannot say that the government budget has been affected by withdrawal funding from USAID and the like. This is mostly off-budget expenditure, and they're not part of the budget, and the Ministry of Finance usually does not track these expenditures. So it will be Ministry of Health to talk about any budgets, any expenditures that are off budget, especially things like what USAID was funding, things like TASO and all that. For us, we focus on what is in the budget, and which is what I've really highlighted. In conclusion, we have a 72.376 trillion budget. It's the highest we have received, we have made over the financial years, and our boss says it's a big, beautiful budget. Implementation will start on 1st July 2025. We make quarterly releases because we run a cash budget, and I thank you for listening. But before I conclude, if people in this meeting would like a soft copy of the budget speech, I will share it with Ambrose. We have a number of annexes in there. The most important being the medium-term expenditure framework, which shows you details of institutional allocations by program. And if you have any questions, I'm really willing to give you some time and respond to your questions. I have not talked about taxation because I think you have somebody coming to talk about taxation. I've also not talked about debt because the minister talked ably on it yesterday. I think he comprehensively covered it. So there was no need really for me to talk about anything to do with debt. So over to you, Ambrose, and thank you for this opportunity.
Right. Thank you so much, Henry, for the comprehensive discussion of the budget. Indeed, we have understood, we have followed your presentation, and we now personally confirm that I can explain also the budget that was read us yesterday. Thank you so much for this elaborate explanation. Now we are in the question and answer session. Participants, please send your question to type in the Q&A. Then we should be able to read. Someone is asking whether slides will be shared. Yes, they will be shared on your email. So be happy with that. You will get the slides. Henry, there is a question from Anonymous. If you are able to see it, you can read through and then respond. Thank you. I need to confirm that you have seen it. It starts with the words like there are grant projects, like you said. You said. Are you able to see that question?
Yes, I've seen this project on USADF.
All right, thank you. So you can respond to this colleague. And then there is another one from Maria Gloria. You may also respond to her as we go to the next session. Thank you.
Okay, thank you. There's somebody who also wanted the budget speech. I'm going to share it with, I don't know if I can share it here, but I can share it with you, Ambrose, and then you find a way of sharing it.
Very good. We would be grateful. You share, send it via email.
Okay, sure.
We have to deliver it. Yeah. Thank you.
Okay. Then the first question, the last question was, I wish the presenter could edit and include infrastructure budget. Now, unfortunately, my presentation is done. Infrastructure budget. So you need information on infrastructure budget. Okay, I'll share this one, and then since I can edit and share with infrastructure, where we put information on things like SGR, Entebbe Airport, how much is going for roads, how much is going for road maintenance, and the like. That's let me note that. I'll share another one with infrastructure. And then have the youth been considered in wealth creation funds? From my presentation, as you can see, wealth creation funds, they're mostly PDM, GROW, which is growth opportunities and productivity for women, EMIOGA, capitalization of UDB, invite, and then there's a 58 billion as I mentioned, under State House for presidential, zonal, industrial hubs, and skilling initiatives. Youth have not been considered per se. They will have to be funded within these wealth creation funds. Why? We used to have a youth livelihood program and a women entrepreneurship program. The youth livelihood program was closed because they were not paying back. What's that thing called where it's a revolving fund and then the youth have to pay back. Whereas the women were paying back, the youth were not really paying back. So that youth program was closed, and now they have to fit within these opportunities. The women entrepreneurship program is still ongoing, but it's a revolving fund. They have 38 billion, and it's a revolving fund. But as you can see, why we don't mention them here is that there are bigger programs which are earmarked, like GROW, which is 231 billion specifically for growth opportunities and productivity for women enterprises. Now, the next question was on health. The next question was, there are grant projects like USADF, which were stalled by President Trump of stop work, yet government provides 50% of the grants total. What plans does our government have in order to complete these projects? Now, as I mentioned earlier to you, these are off-budget projects. Yeah. Now, the plan that the government has was to take over the emergency services that are provided by USAID and the like, and which is mostly this thing where incinerators. Yeah, that was the most critical that government took over. The rest of the projects which are off budget, government will not take them on because they are off budget. The government only operates through the budget. So if the grant projects were stalled, then negotiations have to keep going on with. For them to continue, they have to go on with President Trump to reinstate them. But the government is really not going to take these ones on. No, the government will implement what is in the budget. I hope I have. Let me see if I've answered youth. Could you highlight a bit about the outturn? The budget hasn't yet ended this financial year, so it would not be prudent for me to outline on this, because a lot of revenue is obtained between 15th and 30th of June. So I don't want to commit on the outturn for 24-25. That was from Dostio Mugabe. I think I answered Mary Gloria's Kakai's youth empowerment project. Martin George, help me understand off budget. I've answered that. There's nothing much to explain on off budget. It has impact on service delivery, of course. Oh, the questions are coming in so quickly. There's James. I'm trying to understand, when do we get to see the actual income and expenditure figures? I think we have provided them for 24-25 and 25-26. Our projections of the resource and the expenditure. That's how we present our budget. That is from James. Sheila, is it possible to elaborate more on the financing of the budget? I think I elaborated on that, how government is going to raise the funding. If you could go to the PowerPoint on page 5, I explained how the money is going to be raised. That is to Sheila. And then please explain why schools overcharge UNEB fees. That one now is for UNEB. I'm sorry, I don't have an answer to that. that we can try and get that information, but it's really hard for Ministry of Finance to answer this. The responsibility is Ministry of Education. The budget should show for each allocation the expected source of funding, internal or external. Do not just give a global figure. Patrick Musinguzi, I think, go to page 5, and there you can find a summary of URA, revenues, non-tax revenues, and in the budget, actually, we have this budget by tax head, by non-tax head, how much we're expecting from passports, domestic financing, which is borrowing, that is an easy one. We go to the markets. On external sources, apart from budget support, for the projects, we have them broken down by the respective funder. And we put these in the detailed estimates book, which we are working on, and we shall put on our website, www.finance.budget.go.ug. That was Patrick Musinguzi. Well, are there any other questions?
I don't see any other question after Patrick's question. So I think the questions are done. We thank you. We have about 4 minutes. Participants, if there is a burning question, please raise it up, or you can raise your hand. We give you an opportunity to say out your question. Oh, yes, there is a question from CPA Robert Katuntu. You may respond to his question or comment. Thank you.
An average interest rate of 17% is deceptive. Most local enterprises borrow at 20% plus. Okay. Well, I cannot argue with this becomes a back and forth of, is it 17, is it 20? So I've noted your concern, Mr. Katuntu, but the information that we have is that it has fallen to 18%.
Okay, thank you so much. Thank you, Henry, for a wonderful presentation. And thank you, participants, for your questions, for engaging the presenter on how to understand the budget. And we thank you so much. So on behalf of the Institute, we want to take this honor to thank you, Mr. Henry Carolo, for a wonderful presentation. If it was a physical event, we would give you an accolade, but we will give to you a certificate of recognition via email. Yes, we have
Okay, thank you.
Electronic digital assets, really. So you will use it to, this is the election period. You can also use it, add it there when you go for nomination in case you are interested. You say you presented it to the accountant. So yeah. Right. Thank you so much. I wish you all the best for today. In case you still have some time, we have another session running up to 12:30. Feel free to attend. It is on tax amendments generally, and we hope to also be a very interesting session, just like yours. We thank you so much. So participants, let's go for a break of 3 minutes, then we come back to listen to the amendments in the taxation regime, what we have called the tax implications of this budget. And this session is so key that we also compare our tax implications within the Ugandan setting in relation to the partner states in the EAC. So it is so important that you listen to this session. So let's wait at 11:15. We will start. Thank you. Members, welcome back. It is 15 minutes past 11. Let's be ready to start the session. This session is on the tax amendments, tax implications of the 2025-2026 national budget, and the comparatives between the partner states. In this case, the partner states within the EAC. Yes. So we thank you for your participation in the previous session. And we also thank you for keeping online. We believe you are active there, wherever you are. And in case you have colleagues in an office who may want to listen, please open a TV and they listen to these amendments because we may need them to support you if you're a partner in a firm or if you're a manager in an organization where you are leading a team that is in charge of tax or policy or related matters. All of us need each other. And you know very well that there are cases when someone wants the knowledge to die with him or her. No. Let's share the knowledge with whoever is near to us. You never know along the way certain things can change. So we want to thank you once again, and we are ready. Our presenter is here, Miss Lydia Muhindo. Miss Lydia Muhindo is from Deloitte. Let's please put our hands together to welcome Lydia. Will take us through this session. Lydia, you are most welcome.
Thank you. Ambrose, is my camera clear?
Perfect, yeah.
Okay. Good morning to everyone. And I think more or less say welcome to almost another financial year, which is, we could say Happy New Year to the government of Uganda, even as we close FY 24-25 and we start FY 25-26. As Ambrose has rightly put it, we're going to look at the tax measures from a regional outlook perspective, where I would compare what our counterparts in the region are doing from a tax point of view. That would be Rwanda, Tanzania, and Kenya. And then in comparison to what we have passed as Uganda. So we will so we will look at it in four folds. We'll look at income tax, then we'll look at excise duty, stamp duty, and then the tax procedure code. In other jurisdictions, it's deemed or it's termed tax administration. So we'll start with income tax, and we'll look at country by country. But even as we go through the discussion, we'll compare with what we currently have in our legislation or what we intend to pass from a Ugandan perspective. As far as income tax is concerned, for Kenya, there is a proposal to allow a full cost deduction of items. This is specifically utensils, linen, and industrial tools during the first year of purchase. Of course, this is to enable fast recovery on investment. Currently, what the law provides in Kenya is a deduction of a period of 3 years. So I think this comes in to foster quick recovery from a cash flow perspective for businesses that engage or have a cost or expenses that relate to these items. The next tax amendment is to do with advanced pricing agreements. This bill was first proposed in the Finance Bill of 2024. However, it was not passed, and we have seen it coming back, 2025. Of course, there were wide protests relating to this bill But under the current provision, it allows a taxpayer to agree with the Kenya Revenue Authority an appropriate criteria for the determination of the arm's length outcome for future related party transactions. And of course, the APA, in this case, the advanced pricing agreement would be valid for a period not exceeding 5 years. In addition, what the provision also entails is that the APA would be declared null and void from the date of entry into force if the commissioner determines that there was misrepresentation at while the APA was being done, or where there's misrepresentation in facts that were presented by the taxpayer, then the APA would be declared null and void. Of course, the APA, as we all aware, aligns with the OECD Pillar 2 on BEPS framework, which enhances the ease of doing business. From a Ugandan standpoint, we already have this in our transfer pricing legislations or regulations, and this is Section 9, which allows for a person to enter into an APA agreement with the Commissioner General and over a period of time. However, I think we all appreciate that we are yet to see more and more APAs taking effect. In Uganda, we are cognizant of the fact that the timelines before an APA is fully signed or comes into effect, there's quite a bit of time that's taken into that. There are audits, and we do appreciate how long audits can take, the documentation that is required. So I think from a general landscape, especially from a transfer pricing perspective, as Ugandans, we look to see more and more APAs come into effect. Of course, in instance, this also helps to manage increased number of transfer pricing audits. And in Uganda, we are seeing the Revenue Authority build capacity. They've already built capacity that there's an international tax team that deals with transfer pricing audits. But with APAs, it would more or less, especially for the multinationals, reduce on the tax disputes that arise from transfer pricing audits. The other amendment that is coming through in Kenya is the clarity on the due date for payment of domestic minimum top-up tax. And this domestic minimum top-up tax was introduced in 2024 in line with the global best practices. However, the Act did not provide at the time when it was assented, did not provide for when one was expected to pay tax. So there was a bit of ambiguity and enforcement challenges from a KRA perspective, where taxpayers were not aligned as to when they should remit the tax, but also on the side of KRA, as far as enforcement was concerned, there was no provision that was backing them up in that regard. So the domestic minimum tax, from a Kenyan perspective, just to speak more about it, allows Kenya to levy an additional tax on computed excess profits for a covered person who has combined effective rate which falls below 15% in a given year of income. And going back to what the OECD guidelines provide, the global anti-base erosion rules under Pillar 2, this aims at curbing profit shifting and ensuring that large multinational enterprises are subject to a minimum effective corporate tax rate of 15% in each jurisdiction where they operate. And of course, for what this means then for a taxpayer in Kenya is to ensure that they do comply, given that now the law is specific on when the tax should be remitted. And also the other requirement in the provision is that large multinationals with global turnover of about 700, I think, and 50 million euros, which have operations in Kenya, will be required to monitor their effective rate to ensure that it's within the tax requirement, and then pay and comply with the tax legislation. The other amendment that has come through is the exemption of gratuity payment from tax, especially from public or private sector. Similarly, this amendment came through in 2024. However, the provision was not clear on whether all gratuity was exempted. So this comes in just to provide clarity as to what gratuity is exempt from tax. From a Ugandan standpoint, of course, under our Section 19 of the Income Tax Act, gratuity is deemed employment income and taxed at the progressive payee rates. Moving on to taxation of digital assets. So this one is just an amendment to reduce the tax rate from 3% to 1.5%. Then there's taxation, fringe benefit tax, withholding tax on qualifying dividends and interests. This I'll discuss it as a whole. So from the Kenyan tax law, what they deem fringe benefits, these are benefits that arise from loans granted to an employee at a rate below the market interest rate and is taxable on the employer. And with a new amendment in relation to dividends and interest, withholding tax on interest is now deemed a final tax. We do have a similar legislation, especially for government securities, where the withholding tax in Uganda is deemed a final tax. Moving on, still on Kenya, tax relief on interest payments on mortgages taken for construction of residential houses. So currently what the law in Kenya provides is for one to claim interest payments on the mortgages if you're purchasing or if you're improving your residential house. So there is no provision if one is constructing. So this bill comes in just to ensure fairness in the industry. But also one of the policies or the pillars that was passed in Kenya is what we call the bottom-up economic transformation agenda. And one of the pillars is ensuring that everyone has access to affordable housing or accommodation. So this comes in just to also streamline and streamline with that policy. So in line with the bottom-up economic transformation agenda, which has been deemed better, it focuses on, it has 5 pillars, which to drive economic growth and improve livelihoods. And like I've mentioned, one of them is affordability as far as housing and accommodation is concerned. The other tax amendment that has come through is increase in tax-free daily subsistence allowance for private sector employees. Currently, the current tax-free daily subsistence allowance is at 2,000 Kenya shillings for the private sector, but the proposal is to increase it to 10,000 Kenya shillings. And of course, this as well comes in to enhance equity in the economy. The other amendment that is coming through is reduced corporate tax rate for companies certified by the Nairobi International Finance Center Authority. But just a bit on that, these particular certified companies are required to invest new capital of at least 3 billion shillings for a period of 3 years for them to qualify for the reduced corporate tax rate. And the reduced rates, so for the first 10 years, the corporate tax rate is 15%, and then 20% for the subsequent 10 years. I think looking at the general and on what the minister did read during the budget, that the aim of this amendment is to strengthen Kenya's position as a regional financial hub. And of course, trying to attract multinationals to come and invest. But also one of the requirements for the certified company is that it will be required to hire Kenyans at the local senior management level. Of course, that is that encourages locals to also have some bit of stake as far as this investment is concerned. The other amendment is taxation of startup companies. So startup companies that are certified still by the Nairobi International Finance Center Authority, they'll enjoy a tax rate of 15% for the first 3 years, and then 20% for the subsequent 4 years. And of course, we are seeing this, it more or less mirrors the amendment that is coming through for Uganda, where we are seeing exemption for small businesses. And we'll discuss this when we get to the Ugandan aspect. But also, this is also geared to try to enhance and strengthen Kenya's position as a regional hub. Exemption of dividends earned by certified holding companies and regional headquarters. So for one to be able to qualify for this exemption, what the tax bill requires them to do is to at least reinvest Kenya shillings of 250 million annually, and this has to be reinvested in Kenya. This still goes back to strengthening Kenya's position as a regional and economic powerhouse. So once an entity does reinvest at least Kenya shillings of 250, then they would do qualify for this exemption if they have been certified as a holding company. The other tax amendment that is coming through is the requirement for employers to consider all eligible tax relief and deductions. So generally in practice, most employers, will grant employees the eligible applicable deductions and tax reliefs through payroll. However, the practice is not mandated. It's not mandated that the employer should do so. And so it results in employees having tax refunds and going back to try to claim that refund. And I did experience this during my tenure with Deloitte in Kenya, where you do have a credit on your tax statement, but you cannot claim it. So it's a bit confusing, especially also the clarity, it's not there whether actually you're eligible to claim the credit or you're not eligible to actually claim the credit. But also there are a bit of challenges when it's the individual themselves trying to claim the credit as opposed to the individual, in this case, the employee, as opposed to the company. So this provision, I believe, comes in to address the issue of increasingly many tax refunds that come through, especially from the employees, when you do find yourself that you actually have a credit that may or may not be eligible for claiming. And I believe that if this is well managed through the payroll, then this will be useful to reduce the administrative, like I've mentioned, the burden for the employee to go and follow up on the refund. That will be basically it for the income tax amendments that came through for Kenya. I will move on to Rwanda. So for Rwanda, there were not so many that did come through. We just have two of them. However, for Rwanda, the way they did their tax bills is that they do have also proposed tax bills up to, I think, 2030, if I'm not mistaken. And maybe if they do change, I think they'll do keep updating as and when the changes come or updates are made. So for Rwanda, we do have two. We do have the restoration of withholding tax at 5% on the hybrid cars. And of course, this is geared to environmental sustainability, as well as capital gains tax on sale of shares. And I think just going back to the aspect of hybrid cars, I believe also this is aimed to foster more fuel efficient and less polluting cars. And like I mentioned, it's geared towards environmental sustainability. On the aspect of capital gains tax, looking at the other players in the region, and I think I'll start with Uganda, our CGT is currently at 30%. If I look at Tanzania, it's at also 30%. Kenya currently is at 15%. If I'm to stretch it to Ethiopia is also at 30%. So I think Rwanda is trying to leverage on what the neighbors are doing. Currently, the capital gains tax in Rwanda is 5%. And the proposal is to increase it to 10%. But what is interesting in Rwanda is that the existing rate of 5% is computed. So the CGT is computed as the difference between the sale or transfer proceeds, between the sales or transfer proceeds and the regional acquisition cost. So it does not take into account indexing, which, for example, in Uganda, we do take into account indexing. So I believe if they are to also increase, because without any adjustment in inflation and just looking at the original cost while you have increased the rate, may not seem a fair adjustment. So I believe with the increase in the CGT rate, there's need for consideration as to whether they need to also revise how the CGT is computed and take into adjustment inflation as well. So that is on Rwanda. I will move on to Tanzania. So I'm going to spend a bit of more time on income tax. I will not spend so much time on excise duty because it's pretty much explanatory because the rates are just moving. So I'll spend more time on income tax and VAT, and then and the tax procedure or tax administration amendments. And then for excise duty, I will just run through what the rates are. So moving on to Tanzania. So Tanzania, we did see a number of amendments. And the first one is on reliefs. This is specific to two-wheeled motorcycles, three-wheeled motorcycles, bajajes, as well as goods vehicles with a load capacity not exceeding 50 kilograms. The other adjustments that we have seen come through are mainly withholding tax amendments, and most of them are introductions where they have introduced, and I'll just run through them as well. They have introduced withholding tax of 10% of retained earnings. There's 2% arising withholding tax on payments arising from purchase of raw salt from holders. Then there is 10% on commission. 10% on commission payments derived from sport betting advertisement. We are also seeing an increase on withholding tax from 5% to 10% on insurance and reinsurance premium payments. We are also seeing an increase in withholding tax payments for professional and management fees in the extractive sector. Sorry about that. In the extractive sector, from 5 to 10%. We're also seeing a 3.5% withholding tax on income derived from sale of forest products. We are also seeing an increase in income tax on the alternative minimum tax rate paid by companies for incurring tax losses for 3 consecutive years to 1%. So ideally, the alternative minimum tax rate currently in Tanzania is 0.5%. And this is mainly on the turnover of companies which have perpetual unrelieved tax losses for the current and preceding 2 years of income. However, this provision will not apply to companies in the agricultural industry. It will also not apply to tea processing companies, and then also companies engaged in the provision of health and education. So whereas they are increasing the rate from 0.5 to 1%, there are exceptions. But these exceptions have been there in the law, as just highlighting them for your information. Then the other amendment is to limit the ratio of the carrying forward of losses for businesses in mining, petroleum, oil and gas activities. So the ratio previously was 70%, and it's being reduced to 60%. Then the last one for Tanzania is to abolish the income tax exemption granted for initial 10-year period to investors. And this is especially investors registered in the special economic zones. And I think this would be equivalent to what we have as the free zones in Uganda. However, the catch is that the exemption will be abolished if that investor, if they do produce goods and services within the zone, but then they're not selling those goods and services in the local markets. Just to repeat that. So if this investor if someone is registered in the special economic zone and they're producing goods and those goods are being sold within the local market, then the exemption would not apply to them. So if the goods and services are being sold or exported, then the exception would apply to them. So that's the catch as far as that exception is concerned. Moving on to Uganda. So Uganda, we did have a number of bills come through in the initial publications. As far as the budget reading was concerned, we did see only 2 being highlighted from an income perspective. And that is to do with the exception for startup businesses, as well as the amendment of definition of the term reorganization. So as far as exemption for startup businesses, what has come through or what we see in the bill is the government granting a 3-year income tax holiday for startup businesses established by citizens after 1st July 2025. And of course, like I mentioned, one has to be a citizen. Then the other requirement is that the business has to be registered within, sorry about that. The business has to be registered within an investment capital not exceeding 5 million shillings. And then the citizen should not have previously benefited from this particular exemption. The other requirement is that the business is expected to have filed the business information return, which is already provided for in the law under Section 147. And what the law requires is that this return should be filed within 60 days after the end of the year of income in which the payment was made. And I think this comes in well to boost and encourage young people to create businesses from themselves. As we're all aware, we do have a very, very big gap as far as unemployment is concerned. Everyone is eyeing the office or a white collar job as opposed to being innovative and being able to create jobs for themselves. I think what has also come in handy is that we have seen the Ministry of Education streamline our education system and making it more holistic to be able to prepare students as they journey through from primary, secondary, through university, and ultimately out of the university to be able to be job creators. The other aspect, I think, and this is my opinion, I believe it also aligns with our policy of Buy Uganda, Build Uganda, where we are all encouraged to participate in building a nation, but more specifically with our local resources that we do have as a nation. Moving on to the other amendment, which is on the definition of reorganization. So this particular amendment comes in to grant an exemption from capital gains tax. And of course, our capital gains tax rate is currently at 30%. And we do know that as far as capital gains tax is concerned, we do not have a separate regime in Uganda. So capital gains tax is combined with other business income and tax at 30%. So going back to what the amendment is all about, it comes in to grant an exemption from capital gains tax on transactions where an individual transfers an asset to a company and that they have established, but also under their control. The current definition limits reorganization to transfers between companies where the transferee is controlled by the transferor or its shareholders. So this comes in to just expand the scope to any other person from a natural person, apart from a natural person. And I think, and this is my own personal opinion, I believe this is also intended to further incentivize and by increasing the capitalization of businesses, especially Ugandan businesses, where you keep bearing in mind, especially as a business owner, that no capital gains tax will arise when there's a transfer of assets if the conditions for rollover, of course, are met. So that is our discussion for income tax. I will move on to the value-added tax. So for value-added tax, we'll follow the same format. We'll go country by country. And starting with Kenya, for VAT, the amendments that came through were not so many. The first one being the definition of a tax invoice. So what that bill is proposing is to include an electronic tax invoice issued in accordance with Section 23 as an invoice as well. We currently, from a Ugandan standpoint, we do have tax provisions that do define what a tax invoice is that it has been expanded over a period of time with the introduction of IFRS, with the introduction of digital or electronic services. The other one is the issuance of tax invoice for all supplies. And this encompasses whether supply is taxable or exempt. I'll just linking it to what we have in Uganda. With the introduction of IFRS and URA enforcing of the same, as well as the new e-tax VAT return system, where we are seeing that VAT returns automatically populated. If a sale has not gone through IFRS for a VAT registered person, that means the sale never happened. Or if you made a purchase from a person who is not registered for VAT and has not gone through IFRS, you cannot claim the same. So the system that the URA has tried to streamline, on the aspect of issuance of invoices. And we do believe that even as we do appreciate that even as we interact with our customers or clients or vendors and business partners, someone will ask you, even if you've given me a system generated or an SAP generated invoice, they'll still go ahead and ask you, where is the IFRS invoice? So by that, URA has in a way enforced the issuance of invoices. I think the other amendments under our tax legislation that has also tried to encourage or ensure that people actually are in the habit of issuing invoices is the amendment on the non-deductibility of expenditure above 5 million in one transaction on goods and services for a supplier who does not have a taxpayer identification number. And this came through in 2015 because if someone does not have a TIN, in the event that they are dealing in taxable supplies, that means they cannot issue you with an IFRS invoice. But also ultimately, because they have no TIN, they cannot charge a VAT. But also from an income standpoint, that means you cannot take a deduction from someone who has no TIN. So it has pushed businesses to only deal with vendors or suppliers or business partners that are registered for taxes. The other amendment that is also likened to ensuring that people actually issue out invoices from a Ugandan standpoint is the non-deductibility of expenses. If you purchase from someone, that is for goods and services. If you purchase from someone who is designated to use e-invoicing, and they do not. So if you do purchase from that person and the person should have used e-invoicing and they're not, then you do not take a deduction for that particular expense, unless that expense is supported by an e-invoice or an e-receipt. And we saw this amendment coming through in 2020. So I believe from a Ugandan standpoint, we already have tax provisions that do provide for issuance of tax invoices. Of course, we are cognizant that from a compliance perspective, not everyone is complying, but at least with the new with the new systems and with the new systems like the IFRS and the e-tax VAT return, it has forced people to deal with suppliers or business partners that actually issue them with invoices. Otherwise, they cannot then enjoy a deduction either for input tax or income tax, as the case may be. The other amendment that came through for Kenya is a refund of VAT paid on bad debts. So previously, what has been in the law is that the refund, you could qualify for the refund after 3 years, but now it has been reduced to 2 years. And then the option is then it's now the taxpayers. It's upon the taxpayer to either request for a refund or offset against future VAT liabilities. Then the other one is exempted or zero-rated goods or services. I did not complete that sentence. But what the that amendment is all about is that the tax provision or the tax bill requires that one pays VAT if the exempted or zero-rated good or service is used for purposes other than that it was intended for. So if a good was initially classified or categorized as exempt or zero-rated, however, that good or service is not being used for their intended purpose, then the law comes in to penalize and require the person to pay VAT. And I think it's quite a bit self-explanatory because the intention ideally is to safeguard against misuse of such benefits or tax reliefs, and also to promote, of course, revenue and accountability, especially where goods or services have been designated as exempted or zero-rated, but then used for other purposes as opposed to what they were intended to do. Then the other one is to reclassify zero-rated goods and services that are consumed locally as exempt. So what this is coming to do is ideally for zero-rated goods and services that are consumed locally. Of course, if it's zero-rated, there's a VAT rate, but the VAT rate is zero. But then also what that means is that as a consumer, if I'm dealing in taxable supplies and I'm registered for VAT, I can then claim input VAT on my purchases. However, if they do then go ahead and reclassify zero-rated goods and services that are consumed locally as exempt, what that then means is that as a business, if my goods are reclassified as exempt, it means I'm not dealing in taxable supplies. I cannot register for VAT. When I do purchase goods and services that have a VAT component, I cannot take a deduction for input VAT. So that, of course, increases the cost of doing business on the side of the companies that will be affected once the proposal is passed. And of course, as we are all aware, the ultimate person that suffers this is the consumer, because then what the business then will do is that to be able to recover and to be able to recover on the aspect of not claiming the input VAT that was charged at production level, then they're going to pass on that additional cost to the consumer by increasing prices on goods and services that are being produced. I will move on to Rwanda. So Rwanda, the changes are not so they are pretty much straightforward, I believe. They just introduced rates. reintroduced trade story, especially for hybrid cars. We also saw this under income tax, where they restored withholding tax. So even for VAT, the proposal is to restore VAT at 18%. Then the other one is VAT on fee-based financial services. And then the other one is VAT on fossil fuel. So in 2010, 2010, I think, or 2011, the VAT on fossil fuels in Rwanda it was passed that would then be deemed exempt. However, of course, we have seen our friends in Kenya, they did reinstate VAT on fuel. So I believe Rwanda is following suit as well to also reinstate VAT on fuel. But this has not been the case ever since the exemption came into play in 2010, 2011. VAT on transport services of goods by road. This is also a reinstatement of VAT on transport services of goods by road. This had previously been exempted, but now the intention is to bring back the VAT. I believe this is a good thing because then it would enable the licensed transporters to claim back the VAT. One, that they're paying on the fuel, because as you can see, there's VAT coming through on fuel. So I think now with the introduction of VAT on transport services of goods by road, then the taxpayer is able to also claim the VAT on fuel, as they'll be registered for VAT and eligible to claim input tax on that as well. So those are the amendments, or there's one on VAT on mobile phones. Going back to what came through the budget reading and the rationale for this particular one. Previously, the government of Rwanda in 2010 had granted an exemption for mobile phones. And of course, this was to encourage and improve digital access, but also ensure that everyone has access, affordability, so to speak. Because communication, we are all aware communication is quite a key aspect as well. But we're seeing that the government is coming in to reinstate the VAT on mobile phones. We are all aware the economy with the digital, there's quite a bit of digitalization and people doing businesses, so generating income on mobile phones. So a mobile phone has actually become sources of income, so to speak. So we're seeing the government coming in to reinstate the VAT on mobile phones. So those are the amendments that came through for Rwanda. Moving on to Tanzania. Tanzania, we did have a number of amendments coming through for income tax. And I did categorize them between exemptions. We did see some exemptions coming through. We did see some items being classified, introductions of items being classified as zero rated. We also saw the expansion of definition of online intermediation services. we already have, from a Ugandan standpoint, we already have this specific tax provision. And this is under Section 86, which deals with taxation of non-residents providing dictator services. And specifically, subsection 3C defines over Ugandan Income Tax Act dictator services to also include services delivered through an online marketplace or intermediation platform, including an accommodation online marketplace, a vehicle hire online marketplace, or any other transport and online marketplace. So I believe, from a Ghanaian standpoint, we already have a tax provision, and this Tanzania comes in to also expand the definition of intermediation services to also include an online marketplace platform and networking market platforms. The other amendment that is coming through is the expansion of the scope of financial intermediaries. Then the other one is purchase of goods where payment is made online. So for this particular one, the proposal is to reduce the VAT rate from 18% to 16%. The rationale behind this is, one, to encourage the use of online payment systems, reduce the use of hard cash, and also with digital payments, it in a way simplifies tax administration, where information, because information is now digital, is readily available on purchase transactions as opposed to cash, because now there's an audit trail that has been created as far as that particular purchase was concerned. So I believe that also comes in to streamline on administrative aspect as far as revenue collection and tracking of payments is concerned. For Uganda, as far as VAT is concerned, whereas we saw a number of amendments come through in the initial bills for our budget, we saw one major one, which was to do with the reform of penalty regime as far as non-compliance with IFRS is concerned. Previously, what has been the penalty for non-compliance, it's been 6 million per invoice. And given the outcry, the proposal is to revise it from the 6 million per invoice to twice the tax owed by the taxpayer. That is with regards to non-compliance with the IFRS. I will move on to excise duty. I did mention at the start that excise duty, there are pretty much adjustments or changes in the rates. So I will not delve much into this. We will share the slides as well as a detailed table for the changes in the rates. Ambrose, I hope that's okay. So that I move on, in the interest of time, I move on to the next tax head.
Yeah,
And
it is okay.
okay. So moving on to the tax procedure code, and also commonly known as tax admin for other jurisdictions, starting with Kenya, we did see a number of adjustments coming through. And the first one being agency notices to agents of non-resident persons. This is a very interesting one, because, and why I find it interesting is because most of these non-residents are making payments from offshore accounts. So I'm quite inquisitive to see, and they might have local accounts within the country, but my assumption is that most of the money will be offshore. So it will be quite interesting to see how the Revenue Authority will be able to track down the specific bankers where these non-residents have money, because as we're aware, when an agency notice is issued, the person to whom the notice has been issued has an obligation to remit the money that person has with that particular institution. In this case, I'll take an example, financial institution, up to what they currently have as their balance in tune to the agency notice amount. So if I'm to assume that maybe a non-resident has in Kenya, maybe their bank balance, let's say with Stanbic, is maybe 100,000 Kenya shillings. That means Stanbic can only remit up to that, unless maybe Kenya has information on to which other accounts, offshore accounts. Like I mentioned, most of these non-residents will have offshore accounts where they remit, where they make payments from. In Uganda, I know for digital services, that the URA has tried to streamline payments from offshore accounts using an intermediary bank in Uganda. So yes, that would be quite an interesting implementation that KRA will be pushing for. The other enforcement coming through is, and maybe just to go back on that agency notice, I did mention the aspect of offshore accounts. And the reason why I believe this is important is because what these non-residents will do is that they'll transfer money to a resident bank within Kenya just to make maybe a tax payment. And the bank balance on the resident bank or a national bank in Kenya will always be kept low. So tracking back the offshore accounts will be quite interesting, like I've mentioned. Unless maybe that particular non-resident is doing direct transfer from the offshore account to the revenue account in Kenya, thereby disclosing where the money is actually coming from. Enforcement, which is our next proposed amendment, is enforcement of tax collection, where a taxpayer has appealed against a tax appeals tribunal or court decision. So currently, what the law provides is that the commissioner is preluded from issuing an agency notice if a taxpayer has appealed against the adverse TAT or court decision within the required statutory timelines. However, with a new amendment, is that as long as the taxpayer has appealed, the commissioner or KRA has the mandate to go ahead and issue an agency notice. The only exception to the agency notice is if there's been an enforcement to stay an order. So if a stay order has been granted, then the commissioner cannot go ahead and issue an agency notice or a forced collection. Relating it to what we have in Uganda under our Tax Appeals Tribunal Act, and this is in section 15, the Tax Appeals Tribunal Act requires taxpayers. So once you go to the Tax Appeals Tribunal, then you're required to pay 30% of the tax assessed, or that part of the tax not in dispute, whichever is higher. So from a Ugandan standpoint, we already have a provision that mirrors what Kenya is trying to enforce. And for us is as soon as you think of appealing, then you're required to pay 30%. And of course, we've really seen URA come out aggressively on this particular provision, where they will even issue an agency notice until the person has paid the 30%, because that has already been provided for the Tax Appeals Tribunal Act. The other amendment that comes through is the stamp duty exemption for transactions where the commissioner has security over property for unpaid tax. So what the bill proposes is to exempt from stamp duty, especially where the commissioner may opt to exercise power to use a taxpayer's property, either to security for unpaid tax, or actually be able to what can I use? Collect unpaid taxes, so to speak. So of course, because this is government, it all goes the same basket. You can't be taxing government. So the exemption comes into exempt stamp duty on tax, because the tax that someone is called, if the property that the taxpayer has to be equivalent. You can only convert up to the equivalent of the tax that the taxpayer has been assessed or is expected to pay. So tax on tax, that would be quite interesting. So I think it comes in just to remove the stamp duty on collection of tax. The other amendment that is coming through is the requirement for the commissioner to provide reasons when issuing an amended tax assessment. We already have this under our income tax, the tax procedure code, under the tax procedure code, and I believe this is section 25, which deals with additional assessments, where it provides for the commissioner to make an additional assessment amending a tax assessment. Specifically, subsection 6 provides a criteria or guidelines that the commissioner must follow when issuing that additional assessment. One, they need to notify the taxpayer of what the additional amount is. Then they also need to notify the taxpayer the additional amount from a principal tax perspective, as well as penal tax and interest. Also, what additional period that particular assessment relates to, the due date of payment of tax, and the manner to which someone can object, and also the details as to why that additional tax has arisen. The other amendment for Kenya is waive of penalties of interest arising due to errors. And in this case, the errors are the ones that are specific to the errors generated by an electronic tax system. We kind of liken that to IFRIS, where there are delays in updating the system, which may result in non-compliance on the side of the taxpayers. So that error, that penalty is then waived. Where there's duplication of penalties or interest in the electronic tax system, which is iTax, where there is incorrect registration of taxpayers' obligations, and then any administrative errors which are beyond the control of the taxpayer. Of course, for Uganda, I could say we've had what we call the penalty reversal, which may more or less address errors penalties or interest that could arise due to errors. So one could actually apply for a penalty reversal in the system. But also we are seeing the waivers for penalties for voluntary payment of outstanding principal tax. This may not directly be related to if the penalty arose out of error, but generally this has come through to ensure that the tax burden on the taxpayers is reduced. Moving on to Rwanda. Rwanda, we only saw one amendment in the tax procedure, which they call Tax Administration Act. And this was to do with hybrid vehicles, and we have seen it come through from income tax, VAT, and now tax procedure, or tax admin, as they call it. For Tanzania, what came through under tax admin were two amendments. The first one was to require mandatory interfacing of business systems with a system operated by the Tanzania Revenue Authority. And of course, this is to enhance voluntary tax compliance as well as tax administration at the side of their tax authority in Tanzania. The other aspect that came through was waiver of the requirement to pay the amount of tax when assessed. For this particular one, in detail, what the amendment is trying to do is to waive the requirement to pay the amount of tax which is not in dispute, or 1/3 of the assessed tax decision, whichever is higher, within 15 days from the date of receipt of the decision. So this, I believe this is supposed to enable taxpayers to efficiently plan as far as objecting to the assessment, as well as offer them sufficient time to submit an application for a waiver, which previously is you had 15 days to do that. So this will allow taxpayers more sufficient time, as opposed to just 15 days, which I believe was not sufficient enough for someone to come up with supporting documentation and refined audit workings to be able to support the application for a waiver. The aspect on Rwanda that is supposed to come through under excise duty, so that will be amended when we are sharing the slides. For Uganda, we have one amendment that came through the budget reading, which is to do with a waiver of interest and penalty for voluntary payment of outstanding principal tax, which has been outstanding as at 30th June 2024, provided that the taxpayer pays the principal tax by 30th June 2026. For stamp duty, we did not see much coming through in the region except for Uganda. And of course, for Uganda, I believe this is quite a win, which is the removal of stamp duty on mortgage deeds, as well as agreements or memorandum of an agreement. We have all seen the controversies around what instruments attract stamp duty, especially where the Stamp Duty Act does not explicitly define what an agreement is, and we have to rely on case law. We have seen URA come out aggressively, I think, in a bid to expand the tax base, but also implement tax provisions that have been quite dormant. And of course, this is quite familiar, especially when the financial year is coming to an end. Everyone is looking at tax collection targets. And we did see the Revenue Authority come out quite aggressively, issuing compliance review letters to a number of taxpayers. As far as the financial industry is concerned, the Uganda Bankers Association did come out as a collective body to write on behalf of their members in response to the letter that had been issued by the Revenue Authority to their different members. And of course, URA did come out to clarify on what agreements should be subject to stamp duty, and also provide clarity as to the effective date of compliance would be. And I think it was also quite a bit ambiguous because it was just not clear what an agreement would constitute. I think we did have a case where, if I'm not mistaken, must have been UAP on the aspect of insurance policies, where URA had assessed them stamp duty on that as well. And the ruling was in favor of the taxpayer. Nonetheless, I do believe that as far as enforcement is concerned, because the amendment is not retrospective, I believe for compliance purposes, URA will still come out to push for collection on periods where the amendment was still enforceable. And I think more audits will still mushroom in this regard in a bid to collect revenue. That marks the end of my presentation. I will open it up for open discussion or questions. Otherwise, thank you all for your participation and for listening and for giving me an audience this morning. Over to you, Ambrose.
Yes, Lydia, thank you so much. For a wonderful presentation. Thank you, really. We've gotten a very broad perspective of the region, East African region. I don't know why you people, we don't normally consider the other countries which were recently added. But I know their data is always inaccessible based on the situations in which they are in. We hope to continue and see as they get embraced in the region to also understand their movements within the budget development and speech. So we are ready for the questions. Along the way you hinted on capital gains tax computation from Simon Gareta. There is a question from him. There is also another question from PPA Wilson Casey, the Weaver, and then just 3 seconds ago, a question from Gloria Mary. If you are able to see them, kindly respond. And as we move to the next part of conclusion, we believe that once these questions are responded to, participants will have about 5 minutes close. That will go into the financial year very ready to support our economy as accountants. Thank you. Lydia, you can respond to
Okay.
this. questions.
Thank you very much. So in regards to the question that have been asked, there's one on indexing. So actually, our Income Tax Act does provide guidelines on how the indexing can be done. I had not picked that particular section in the act. I'm trying to look it up. But it does provide guidelines. Just give me a minute. That caught me off guard. I had not actually looked it up, but our Income Tax Act has, which section would that be? Yes, so in our Income Tax Act, Section 153, Section 153, subsection 7, it provides guidelines on how indexing can be done. And of course, for clarity, we'll need to do maybe a hypothetical computation or something like that. But if you go back to the Act, there's a section that provides guidance on indexing. I'm sorry, I've not given you a detailed response because for us to properly dissect it, we'll need to have a hypothetical example to work with. But yes, that in the Income Tax Act, if you can look at if you can go to Section 153, there's guidance on how the computation for indexing is done. So yes, I think I'll move on to the next question. Does waiver of interest and penalty apply even when there is an assessment? That's a very good question. So what the law says, or what the provision is saying is that there will be waiver of principal, your penalty and interest, subject to payment of principal tax. And just to take you back, maybe one of the scenarios under which interest will accrue or penalty will accrue is if you've been assessed. You may not have been assessed, but maybe you made a late payment and you've not yet been assessed on that late payment, but your ledger is already computing that. So yes, the law does not, there's no, it doesn't, at least based on the proposal, on the bill, it does not exclude assessments. Unless that guideline is provided, but it just says if you have a penalty or an interest and you've paid principal tax by the due date, in this case, which is 30th June 2026. However, that interest accrued has accrued by was accrued over a period of up to 30th June 2024, then you'd be eligible for the waiver. We've seen this come into play more specifically during ledger reconciliations, where people are encouraged to pay the principal, and then the ledger is reconciled and the interest is waived. But specific to the periods to which the waiver applies. So for now, it applies to interest and penalty that has accrued up to as at 30th June 2024. So any interest from 1st July 2024 to date is not covered under the waiver, even if you've paid the principal tax, unless we see another amendment coming through the next financial year. Then is there a threshold on the amount invested by a citizen for one to be exempted from income tax for a period of 3 years? I believe I did mention that the investment capital not exceeding 5 million shillings. So the exemption applies if the business is registered with an investment capital not exceeding 5 million shillings. So that is what is coming through in the bill. I hope I have answered that question as well. So someone has typed the induction uses storage. Okay. I don't know if that's a question or someone is commenting as well. Okay. Okay, so I'm seeing people have provided responses as to the indexing, but yes, the Act does provide guidance on how the indexing is supposed to be done. And I think like I mentioned, for you to appreciate the calculation, the formula, we will need we'll need to deal with hypothetical numbers. Okay, there's another question. Is the waiver if a taxpayer has forgotten to file return in time? So if you fail to file a return in time, depending on what the scenario is, either you have a penalty for not filing, or you could have an additional interest where the return has not been filed. If the principal tax was paid or has been paid by the due date as stipulated in the waiver provision, I believe, but just keep in mind that we are looking at interest and penalty as at 30th June 2024. So we are looking to tax returns that were filed up to 30th June 2024. So any other returns after that period are not covered within the waiver. Based on my experience on ledger reconciliations, we have seen the Revenue Authority actually, because the tax statement then shows you what interest has been waived, we have seen them come through to waiver if the period falls within the tax provision for which the waiver applies or for which the return applies. I don't know if there are any other questions. I think that's basically it.
Thank you so much, Lydia.
Oh, so someone is asking,
Yes.
what happens in a case where I have no principal tax to pay, like I'm exempt, but I have a penalty? Why is the question has disappeared? Wait, it's
The
just my
question is still there. It is there from Edith.
okay.
Yeah, you can, it is still there.
What happens in a
Only we
case?
read it.
Yes. What happens in a case where I have no principal tax to pay, like I'm unexempt, but I have a penalty and interest for 2024? Quite an interesting question. And I'll answer it in twofold. Depending on the tax head, if it's VAT, remember VAT, we're dealing with compounding. And you'll notice that your interest will then now become your principal. So the exemption, I believe, applies to income tax, and then maybe depending on if the person provides more clarity as to what tax head we are dealing with. If it's VAT, if you're exempt from VAT, then we are not seeing you filing any return. You're not registered even for VAT at all. If your income tax exemption, okay, so the person has said the exemption applies to, okay, so the exemption applies to income tax. I believe the provision should apply because we are saying in the first place I don't have any principal tax to pay. So my understanding is that if you have no, what's amending the return? My understanding is that if one that check the first criteria or the first thing that we need to ask ourselves, do I have principal tax to pay? Have I paid it? Yes. If I don't have and I still have penalty and interest, and the provision does allow for waiver of that interest and penalty, that interest and penalty should be waived, even when there's no, if you're exempt and you have no principal tax that you're paying. I believe it should apply as well. Because the first check that URA will confirm is whether you have any principal tax outstanding on that particular tax head that needs to be first cleared before you qualify for the waiver. So if you don't have any, then I believe you should qualify for the waiver of the penalty and interest if it falls within the provision for which the waiver provision for which the return relates to.
Okay, thank you so much. The other questions really are almost the same. I see this is asking the same question. On that note, we want to thank you so much, CPA Lydia Muhindo, for a wonderful presentation. We also want to thank our participants for the questions asked and the engagements, the active engagements we had with the presenters. We will continue interacting on cpd@icpau.co.ug. Should you have any question that relates to these sessions which we have concluded, please send them. We can respond to you. If they are beyond our height, we shall also correspond with Lydia or Henry, and we come back to you. Otherwise, we thank you all for your participation. I know yesterday you listened to the speech. Today you have listened to the technicalities of it. And we believe that you are ready for the next phase of the financial year as professional service advisors. Our hashtag here, you know very well, it is creating impact. But the way we do so is that we enable you, the members, to create the impact. The institute is just a conduit of impact creation. So we thank you, our presenters, for sharing your knowledge, experience, and sparing your precious time to be with us. I know, Lydia, you were supposed to be somewhere, but you have really said, let me come to the professionals, and the team has distributed. We don't have Martin here. I know he's that side helping with the rest. So we thank you so much, team from Deloitte and the Ministry of Finance. Otherwise, we want to close. As we close, Lydia, we normally give the certificate of presentation, recognition. But we are going to give it to you on email, electronically. Yeah. So we'll send it to you on the email, and the rest will also follow. That is the same story with our participants. Email, check your email, as well as your certificate for your slides and others. Should you not, CPD@icpau team will respond to you. So you write your email, cpd@icpau.co.ug. We shall be of good help to you. I wish you all the best. See you next time. Yeah, thank you. Good.